Crypto 2021, what's top of mind in crypto? And a great topic, considering we started planning for this in November. And if we set all of our themes to what they're going to be in November in crypto, we would have been severely out of date. And if we set them 2 weeks ago, we would have been severely out of date. So we're really happy to have an amazing panel here to discuss about what's happening today and in recent weeks in crypto. Cecily, why don't you go ahead and take it away?
Excellent. Thank you so much, Nick. Good to see you. Thanks for having us. You're right. When we did first envision this a couple months ago, we knew we'd be doing the planning and the substantive thread pulling kind of last minute, but it's actually been last minute. We just had a chance to huddle right before the call. And even what we would have talked about earlier this morning is a little bit already old news by now. So we've got a bunch of great topics to cover and 3 awesome panelists here. I'm going to encourage each of you in the order of Dan, John, and Jake to introduce yourselves. I'll go first, and we'll just keep this super quick. Cecily Mak, great to meet you all. I'm currently a partner with Consensus, do primarily portfolio management and a lot of hands-on work with a whole spectrum of startups in the blockchain crypto space. And really happy to be here back for a digital version of your great events, Howard. So thanks for hosting. And Dan, I'll pass it to you.
Thanks. My name is Dan Elitzer. I'm a co-founder of Nascent, which is a multi-strategy crypto investment fund. We got started towards the end of last year. I previously spent 5 years at IDEO, helped start IDEO Collab Ventures there, and way back when founded the MIT Bitcoin Club.
Excellent. Thank you. John.
You bet. Hi, everyone. I'm John Fiorelli. I'm regional partner at Kinetic based in Hong Kong. I also moonlight by advising some great projects. Specifically these days, I'm spending more time with Blockdaemon in the node infrastructure space. Started in the blockchain space back in 2017, starting the advisory business with Kinetic, and have spent a lot more time working with projects, not only on fundraising, but also product strategy and business development.
Awesome. Thank you.
Awesome.
Jake?
Thank you. My name is Jake Brukhman. I'm a CEO and founder of CoinFund, which is a blockchain-focused investment firm based mostly in New York, operating in space since 2015. I'm an investor, engineer, also researcher of crypto economic networks, and more recently, an art curator at firstedition.xyz.
Excellent. Thanks, you guys. Good to have you on. We have, as I noted in our little huddle before the call, we realized that one thing that we would have maybe talked about if this was an earlier morning panel would be what's being referred to as the plunge of the day. It's been beaten to death, but it does trigger one topic that I think is on mind and maybe a little bit more universal, which is how we are looking at this particular period of time compared to what we saw in 2017. And what any of you might have to say to folks who think this is a similar tracking. Like, what's different about what's happening today, 2021, trends in market, from what we saw in 2017. And I might ask you, Dan, to kick it off, and then we can follow the breadcrumbs.
Sure, be happy to. So my perspective is that 2017 was largely about ICOs, initial coin offerings, and there was just a lot of hype around that. At the time, there weren't really stable coins on Ethereum. So to get into ICOs, people had to go into ETH, which pumped ETH. And there was just a lot of hype around white papers and very little actual working product. This time around, it's been Bitcoin driving the train. And it's hard to really imagine a more favorable macro backdrop for Bitcoin generally. And as Bitcoin is going up, it's kind of dragging everything else along with it. Oh, and by the way, DeFi is now a real thing. We've got these huge protocols handling billions of dollars in transactions and loan volumes. So there's real usage happening there. So when you take this big macro trend and then you pair it with really kind of the rubber hitting the rails or the road on this new space of decentralized finance, it really is a lot more meaningful and I think has a lot more legs. Not to say that valuations and everything we're seeing hasn't gotten pretty frothy, but there's something real useful there. So, it's I don't think we're going to follow the same pattern as 2017, but who knows where prices are going to go over the next weeks and months.
Any additional thoughts or compliments to that, John or Jake?
Yeah, I mean, just in agreement with Dan. It's different now because you don't have a lot of projects who raised a ridiculous amount of sums in ETH, and so we're not going to have a steady hard sell pressure that lasts a year and a half. Those projects needing to pay bills. Also, those projects have spent the last 3 years building, and they launched predominantly in this past year. So not only have they launched, but they've offered opportunities to stake, and a lot of the large early supporters are in. Kinetic being one, CoinFund being another, nascent. So all of us are playing in that game to help secure the network. So this is very different. To the degree, however, that institutional funds putting percent or even bips of their assets into Bitcoin, it's flowing into other assets too. We're seeing, at least in some of the things that we're seeing in Blockdaemon, there's clearly interest not only in going into Bitcoin, even if it's just store value, but even to participate directly in staking. So we think that'll increase.
Awesome, thanks guys. Yeah, very much in agreement with everything that you guys have said. Let me take the kind of the fund manager, like institutional view. I mean, totally agree with you, Dan, that Bitcoin is really driving this. I think what just happened is that we broke the mental models of institutional allocators in a positive way. So let me explain what I mean. They're looking at Bitcoin going up to 20K in 2017. They're like, this can't be real. Things don't move that fast. Just to make sure, let's buy it at 20K. Then it crashes to 3K. They're like, I told you this was a scheme of some kind. This just validates it, right? 3 years later, we are right back at that 20K, and when we break through that historical level, I think that resets the mental model. Okay, this is not something that is that was a Ponzi scheme and kind of fell apart. This actually survived, this market. This is real. We need to take another look at this. We need to understand what it is. And I think what we've seen sort of since December is that a lot more institutions are paying attention to space, writing checks. And I mean, Elon's $1.5 billion Bitcoin buy is just the icing on the cake there, which I think for our industry marks really the phase of consumer and corporate adoption of crypto. So it's very exciting going into this year as a fund manager.
Are you saying, Jake, that Bitcoin is too big to fail?
No, I don't think I'm saying that, but I think it's definitely the entry point for folks. And as you noted, it's not just Bitcoin that they're going to be putting on their balance sheet. That much is clear to me.
Yeah. So, and you guys in your various roles do have an eye, I'm sure, on some of the regulatory considerations as well. I think there's still a lot of TBD there, and there may be some folks in government who have near the level of power and influence Musk has in statements and the like. Do you have any thoughts about where we sit today from a regulatory standpoint, and where you think or predict or would like to see the pendulum land in how we want to attempt to control or regulate what's currently very much a wild and an innovative space and market?
Sure, I could take that one. I think like broadly, regulation is always very scary, right, in nascent markets, but over and over and over in blockchain, we see kind of favorable regulation. So I remember like early 2018, we're sort of sitting there looking at the market and hoping that, oh man, if the SEC says that all tokens are securities, we're going to stifle a lot of innovation. Actually, the SEC did a very cypherpunk thing, right, and said, oh, some tokens are securities, some tokens are commodities. By the way, they can transmogrify into each other. And it's really like, it really landed in, in a place that makes sense. I think we see that kind of consistently. The heads of the 3 major regulatory agencies, at least in the United States, that are relevant to crypto, CFTC, SEC, OCC, are now headed with people who, very much are plugged into the space. And I think like just the key here is that founders need a path, right? Yep. If they know how to comply, we're already in a much better world, and it really looks pretty favorable.
I would agree with that. Certainty is really more productive. So if we're going to have a regulated environment, which eventually we will be, projects like Stacks proactively, pursued a more regulated approach. and they spent a lot of time and money doing it, but they did it because they wanted to be, they want to have some measure of certainty in the United States. And I couldn't comment on the challenges that they had with it, but some projects chose to go that route. And there have been, I guess you could say, licensed broker dealers who want to, help them do that, right, in a way that's seemingly compliant in a securities environment. The thing is that, regulation comes in commissions, it comes in legislative bodies, it comes in the courts, and I don't know if we were talking about this a little bit earlier, but, there's a little attention on the Tether settlement. I think it's definitely a piece that didn't go to the courts. It could have, but I think it starts to provide us a clue into how regulators, whether it's state attorney generals or what have you, are thinking about this stuff.
Yeah.
I wonder if regulators also necessarily want to be the ones that crush it, and especially crush it in the United States. So thinking from an Asia perspective, I think we're all curious how it will play out in the US and Europe.
Right. I'm actually going to take that and volley it over to Dan. For those who are not familiar with the context of or what actually happened with the Tether settlement, are you comfortable giving the crew here a bit of a rundown of what matters? What happened? What is this?
Yeah, so I mean, so please jump in if I'm messing up some of the details. But basically, the New York AG announced a settlement with Tether, or it was Tether Inc. or IFNX or something. So one of the entities behind Tether, and slapped him with, I think it was like an $18 million fine. And there was no admission of wrongdoing or anything like this. But basically, like I haven't run the exact numbers, but I'm pretty sure Tether prints that much, like at least like per month, and just like in profits on the float from everything they've minted. So like it's a nothing fine. And so the AG gets to say, we're being tough. We're not letting these crypto cowboys run roughshod over our laws. While at the same time, the crypto ecosystem just kind of had this thing hanging over its head. I mean, I don't think most of us were really feeling much concern about where it was going to end up. But Tether is now here to stay, is what it seems like. So I think this is just setting up a pattern where we've seen previous big actions, like with the Block 1 settlement as well, where given the amount of money at stake, it's really been a nothing settlement. And I don't think this is actually the message the regulators want to send. And I've actually heard a few of them push back very strongly against this. But basically they're saying, just do what you want and just like pay a fine later, and it's going to be a nothing fine. And so I expect, SEC and Ripple will probably end up in a similar place. There just isn't the resources in these agencies to really pursue against these very, very large entities with a lot of cash. They're not going after them. It's I think benefited from the real gray area that a lot of this stuff sits in, right? I think Jake made a point about regulatory clarity. I don't feel like we have that. There's still there's some really, really, egregious stuff that has been slapped at and said that's definitely not okay. And then there's some like ridiculously tame stuff on the other end of like tokens that, must be only given to whitelisted participants, must be redeemed at $1 only for services from this particular company. It's like gift cards that are not freely transferable. Like that's okay as a token. And then there's this gulf in between those things where we really just don't know what's okay. And I spend time with founders every single day just talking about like, where do we want to fall within this gray area? And I think more and more it's becoming harder not to say like, just go with whatever you think is the right thing to do to grow this project and make it successful, because we don't have that regulatory clarity. And just don't do anything that is not okay, and try not to be any more egregious than what you think are, if there are good actors in the space, position yourself on the more conservative side of what you view those good actors doing, and just go for it. And I think that's where I think we're netting out on a lot of the regulatory stuff right now.
Excellent point. Howard, I see you have a potential prompt question in the chat. I'll let you unmute and let us know if someone wants to chime in. But if not, we'll see if
I'll let you know. He hasn't responded, so.
Okay. And we were thinking, if we had 5-10 minutes at the end of our segment here for questions too, we're really happy to have you facilitate and do that in the easiest way possible. So that's a great view, and I love it that you wove in a bit of a prediction on Ripple, and myself coming from a long line of following industries make this uncomfortable and clunky adjustment from analog into digital, whether it be first I did music, then publishing, and now I'm in currency and blockchain. I think this is following a trend there, and for those of you out there trying to predict how our governments, at least within the US, we do have a separate conversation about balkanization, Nigeria, India, elsewhere, but at least within the US, which is very heavily trend setting and is a good ground zero for a lot of remarkable business and innovation in this space. I think the way you describe it is a bit like bumpers, which is great. It does enable this ongoing innovation. Let's shift gears a little bit. I want to get to another super hot area that has come up in all of our kind of precincts directly or as a group, which is NFTs and the emergence of the significance of NFTs. I know, Jake, you do a lot of work and have a lot of attention in this space. Give us a little bit of a skinny on what's top of mind for you and your firm with NFTs today, and what people should maybe be thinking about that they're missing because we're seeing all this noise around big, massive currency price fluctuations and founder tweets.
Absolutely. Thanks so much. Yeah, at CoinFund, we've been following the NFT space for quite a while. I'm actually a digital creator, so I've been following NFTs since Rare Pepe's on Counterparty in 2015. We made some early investments in the space. We did Dapper Labs in 2018. We did a very early kind of NFT startup called Additional. More recently, we preceded Rareable, which is one of the major NFT marketplaces by volume. Mm-hmm. I think like one interesting thing to note is that when people sort of think about NFTs broadly, they tend to think about art, collectibles, in-game assets. That's what's visible out there. Everybody's buying art. But actually, like, the art use case is a little bit of a disservice to what NFTs are. They're just so much more general than that. And that's what I wrote in our thesis, which you can find on our blog. And what I'm basically saying is, if you take a look at digital content broadly, and you think of NFTs as property rights to digital content, suddenly you can throw in addition to art, in-game assets, and collectibles, you could start throwing in stock photography, movies, music, 3D models. You can throw in fonts. You can throw in digital plugins that happen, that are sold for like Photoshop, or like audio plugins that people sell on these marketplaces today. And that is actually a core value proposition of blockchain technology. We want to replace middlemen of markets with smart contracts. And when we do that, we gain a lot of value. We gain a lot of efficiency in exchange of these things. And so for me, I mean, art, look, it's a $2 to $3 trillion market. I think it's going to be huge. We're already seeing it be, kind of have early fit. But things like fonts, like if you just think about, or stock photography, right? People don't have to give up all of their rights anymore. They can retain some rights to their photographs, and yet they can still extract a lot of value personally from putting these things on open marketplaces, putting these digital content in open marketplaces. The other thing to think about is music is a great use case. I think music is like the next big thing in NFTs. Mm-hmm. You can take the royalty stream of a piece of music and start to divide it among the creators of the music. The drummer gets a little bit, the singer gets a little bit, right? And then as an asset, this becomes a fundamentally valued asset. That's the thing that people miss when they're looking at NFTs as art. Art is great. Art is speculatively valued. Its value is in the eye of the beholder. But when you start thinking about NFTs as a cash flow bearing asset, then you can start to create fundamental valuations. Taylor Swift songs, that's the example, right? My wife is a huge fan of Taylor Swift. It's my dream to give her like an NFT one day where she can not only own the song, but also like maybe earn some of the royalties from that asset going into the future. So I would say for me, it's a huge asset class because of the diversity of assets. And when those assets go from previously illiquid to liquid using blockchain technology, that is going to be one of the biggest IPO-like events of all time.
Yeah. What's your prediction on timing wise for that? How close are we?
I mean, it's happening now. We're seeing Dapper Labs put in some incredible sales volumes. I think the other day, or I should say, within the last 24 hours, Roham tweeted that Dapper generated $38 million of volume in a 24-hour period. Just to put that in context, that's more volume than all of CryptoKitties' volume ever in all time in a 24-hour period. And this is all coming from mainstream users, basketball fans, you know, that have a huge affinity to NBA Top Shot assets.
Yeah, incredible stuff. Awesome. Thank you for that.
Just one thing to add to this, Jake, I think you nail it. You talked about market size for some of this stuff, and I've got some ideas about other reasons that I'm also interested in NFTs. But generally, when you think about digitizing these assets, it's the same way that we used to compare, or some people were officially comparing the market opportunity for Uber to the market size of taxis, right? It's like once you have something that's digital and that just lowers the barriers to entry into use by so much, you're actually going to massively increase the sizes of all these existing markets that are being touched here. And so while I do think it's helpful for us to think about like, well, what are the different markets that we can bite off with crypto generally and NFTs specifically, remember that we're making these global, we're making these more liquid, we're making them much more accessible to everybody. So it's going to be multiples of the existing markets that we're comping to in terms of where this ultimately ends up.
Yeah,
absolutely, Dan. I mean, like on Uber, right? I think the anecdote from San Francisco was Uber hoped to take 25% of the cab market. They ended up taking 125%. How could you even do that? Well, you've opened up a new market of people that will order cabs because it's easier on their phone. And in the same way, like what I'm seeing in art right now, there's a huge middle market of creators that would never even dream of trying to make art as, you know, kind of their primary money-making activity. However, given the efficiency of blockchain technology, of NFTs, of these global marketplaces, they now can actually have a sustainable model to earn a living being an artist. And that's actually related to what we're doing at firstedition.xyz, where we're launching artists who haven't been able to previously monetize their art before and now can do it on chain. And it's really exciting. It's super game changing. And the royalty streams, which is another thing to talk about with respect to NFT art, are absolutely game changing for creators.
Yeah, big, awesome stuff. Okay, I'm going to switch gears one more time because we are going to run out of time. And we had a long list of cool stuff to talk about today. We have also seen your own portfolio of projects and investments. Let's thread a needle a little bit on the implications for L2 versus L1s. How are we going to see these as solutions to this cost problem and other innovations you're seeing as this shift rolls out?
This is kind of almost a 3 to 4 year debate as we've been seeing all these networks come online. And most recently, and this isn't really big news, but a lot of layer ones are acting as layer 2 to Ethereum. You know, we're still settling on Ethereum. Our core assets are there. And we need a place where we can be composable and where we can trade. The problem, of course, is that today no one can trade anything. It's really expensive. It's slow as hell. And so we need something that works. Now, obviously, I think a lot of us are really excited about ETH2, but we've got some time before that's going to be functional, or before we can even transfer our ETH2, 18 to 24 months, depending on your take on it. So in the meantime, you know, networks like Solana and Serum are working to provide, you know, an interim solution. And then there's layer 2s like Scale that are trying to provide some form of a solution in the meantime. You know, you want to stay native to Ethereum? Great. We've got a way for you to do that. I think the real question is, you know, how well will these networks respond to the demand? Because the demand is really, really strong. If we've seen anything this summer, DeFi is here, it's real. There's gonna be a lot more money pouring into it. To make layer 1s work as effective layer 2s and to prove out that thesis, if you believe in it, is how functional these bridges are going to be, how much are people funding the liquidity between them. We're seeing projects like Wormhole that Solana and Terra are using to bridge to Ethereum, and we'll see how that plays out.
Mm-hmm.
So I think where we are now is it's really early. Outfits like Blockdaemon are working hard to provide infrastructure layers to support that, as are a lot of our peers. So I think the next, I'll swag a 6 to 12 months is really where we'll see where bridges play, because by then we'll have a sense of where ETH2 is, and then we're going to start to see our bets narrow.
Yeah. Any additional thoughts on that, Dan or Jake? An alignment or twists in perspective?
Yeah, I think I'm somebody who started off with a very Bitcoin maximalist view and then kind of came around to seeing the benefits of building on Ethereum. And I think it's really over the last few months that it's become increasingly clear that it's not just about L2s for Ethereum, at least to me. I do think that Ethereum L2s will be big. I think Ethereum will continue to be big. But if you look at some of the technical challenges of having to bridge L1 to L2 or L2s to each other, those are very, very similar to the technical challenges of bridging across multiple L1s. Yeah. And while those of us who are here and who are building may have very strong beliefs as to decentralization or as to optimal architectures, ultimately, most of the people who are going to be using these systems are not here yet, and they really are not going to care. Not that it's not the job of builders to in some ways care on behalf of their end users and to think through that, but I think that there is going to be a wide spectrum of performance and decentralization that we're going to see applications all the way along that spectrum. So it's not going to, Ethereum is not going to be the be all end all. It's going to be a very, very big piece, but there's a lot of more room that has not been explored yet.
Excellent. I see you've joined us, Howard. Welcome. Yeah. Sounds like there's a question.
Yeah, I have a question, maybe two, since I got you guys, and this is a fantastic group, and I'd love to tap your brains. So one question I have is, I don't know how many of you were on this morning, but one of the themes that was discussed, and I think it's a great subject to have your opinions on, is the speed and modalities of the bridging the gap between the crypto community and the traditional business community, including financial services, right? I mean, you talked about that a little bit earlier in the session, but on the one hand, I think we've seen DeFi make a lot of things possible, make bridges very possible, and you have the traditional financial institutions reaching out to join into crypto. On the other hand, you have lots of barriers as well, both practical, market, but also regulatory. So I mean, you get the sense sometimes that if the two sides want to shake hands, the regulators will be very nervous unless both sides are heavily regulated, or at least regulated in the same way. So does that mean that effectively, if you as a crypto platform are going to be effectively integrated with traditional financial institutions, regulated financial institutions, that you're going to be equally regulated and equally subject to restrictions, and so therefore you're going to back off? And there may be lots of other issues associated with building these bridges, but that's an example, all right? But the other observation I would make is that there's also bridges that people are building from crypto to just the ordinary retail market, right? I mean, up until recently, you had to be kind of a specialist and a nerd to be able to engage in this community, right? But now, I mean, I feel like it's actually, the vocabulary and this discussion is a little more and more accessible, partly because you don't have to actually understand the plumbing to really understand what's happening on the business side sometimes. And so I run into a lot of people that seem to know what they're doing. And when I ask them, a little more specifics about what's happening underneath the covers, for example, they may not be able to tell you, but that's fine, because what they understand is the business side, not necessarily the technical side. So maybe you can speak to just these bridges that are building or not being building between the crypto community and traditional business finance and ordinary people.
I would actually nominate John for a first pass on that, just because I know that you do this all day long and you've got a perspective.
Somewhat. First of all, Howard, I think that's a great question for what you would call traditional institutional investors or asset managers. A lot of this stuff is abstracted away, and at this point it should be. And when you're getting into regulatory issues, it really comes down to who's custodying the assets and who is providing the guarantee. So right now, and I'm sure Jake can even comment on this, a lot of funds, a lot of crypto funds are raising from traditionals, whether those are endowments, whether they're from sovereign wealth. There's a lot of money that wants to come in. They don't want to engage at the level that we are. They don't want to deal with it on a day-to-day, and they don't have the bandwidth. So it works to have some abstraction to it. And as those funds get more sophisticated, they can come a little closer. So maybe you're comfortable going into Bitcoin. Maybe you're comfortable owning ETH and even potentially staking ETH. Eventually, those larger ones may, and we're starting to see interest from what you consider more traditional folks. And at this time, it's like family offices, right? And they're dabbling with the idea of staking, even yield farming in some cases. So there are some who are, yeah, totally. I mean, there are some who are willing to, play, but most don't. And that's why I think we're seeing, I guess you could say, consolidation and platform integration. And, you see some of these announcements coming out, like Fireblocks is going to be supporting BNY Mellon. Neither want to comment on it, but, to the degree that we're seeing kind of crypto native outfits providing sophisticated custodial MPC technology to major financial institutions, we're going to see more of those announcements, but they need someone to kind of take care of the crypto native stuff. The other thing too is I think we're going to see more consolidation in our space. Even the large crypto funds, they may or may not want to be working with so many different service providers to make staking work. They may want to work with like a single place, custody, node infrastructure, APIs, everything. And so I think there will be a game of musical chairs in our space.
Yeah.
I would add, like, can you guys hear me?
Yeah.
Yeah. I would add, that conversation with traditional allocators, Wall Street folks, sort of, people who are just coming to the space now, has become a lot easier with the emergence of decentralized protocols that have fundamental value, fundamental cash flows. It's actually kind of amazing, Howard. You can pull up a website, you can show folks, look, here's a protocol that's doing, lending or a money market. Here's all the cash flowing through it. Here's how much take rate the protocol is taking. Here's how many tokens are voting on whether to redistribute those cash flows, to token holders. And all of that data is open, public, accessible, auditable, immutable on chain, right? And it's a much better structure to show fundamental value in many senses of the word. The other thing I would say is, when we think about investing in like DeFi at CoinFund, what we tend to do is we tend to zoom out from like DeFi and tokens and blockchain a little bit and say, like, what is the actual process that we're observing here? And that process is actually the convergence of blockchain technology and crypto networks very much with the traditional world, with governments, with regulators, with banks, with corporates who are adopting this, with companies who are using this as a competitive advantage. And when we think about investing in DeFi, it's not just about tokens, it's not just about yield farming, it's also how does that technology get adopted over time in practical, responsible ways, that create value. And so, that's another reason why, like, investment in DeFi is not just investment in blockchain. It's also investment in companies like BlockFi. It's folks that are providing kind of infrastructure and middleware for that space, folks that are integrating with regulators, with compliance technology, right? It's actually quite a bit more rich than just DeFi.
We're almost out of time, but let me just follow up with one quick follow-up question. So, one of the things I find very interesting is the move towards protocols as opposed to companies, right? And we talked about that earlier in the morning. And I think it'd be interesting to track the number of times in crypto conversations the word company is used versus the word protocol is used, right? Because over time, I'm guessing the one is going to go down, the other is going to go up. And I'm just curious what you think is going to happen eventually, because are we going to see the slow extinction of companies as a kind of an actor in this stage, where the value is really protocols and companies sort of go away, wither away? Or are companies going to always have some some role in this ecosystem, despite the fact that protocols are more and more important.
I think companies will always have a role. And actually, on the protocol question, one of the things that we saw become a trend over the summer was this idea of these kind of fast follower forks, or these fair launch forks, where you take a protocol that existed, then someone would just say, okay, we're going to copy it, relaunch it, and then distribute tokens to a whole bunch of people and try to like have that take it over. And SushiSwap did that to Uniswap and actually kind of became successful doing their own thing that they evolved into, but largely these forks were failures. That was somebody who's coming in doing a really cheap copy, easy copy. What happens when you get some of these larger fintech players or traditional financial players, probably more the fintechs realistically, or someone in the consumer internet space who comes in and says, we literally have 2 or 3 orders of magnitude more users than an existing protocol, and now we're going to fork your protocol and use a bunch of tokens going to the users. I think that's a much, much bigger threat than we've seen any of these protocols deal with to date. And so I am very excited and curious to see what will happen when we start to have this knowledge of the value of owning a significant piece of an open protocol filter into the people who have millions, tens of millions, hundreds of millions of users, because we haven't seen that play out in crypto yet.
It's a good point. I mean, there are projects who've openly said that they want to be not actively day-to-day involved with their own protocols within 6 months, 18 months. And the fast forks are probably on the earlier side. I think we'll continue to have companies. I mean, anybody who's running money right now is a company, and they have LPs and they are GPs, and you will have, and by the way, the word that I see more is projects. We see projects, and those are either protocols or companies, and they build something and they sell something. So I think there'll always be room for companies. The funny thing is that, your point, Dan, is that you're absolutely right. That is happening. There are large companies. They may or may not fork something that's already out there. So they may not be doing a fast fork per se, but they're going to be playing in a big way, because the product is not the protocol itself, it's the liquidity. If you've made it interesting enough to commit capital and collateral to a protocol, you have it. You have open source code, but you really just have a network. So I think that the real question that I have is, how do we reconcile where the ones who form the protocol give the keys to the kingdom, let everybody run it through governance? I think we're going to have a period of really testing what governance really looks and smells like. We're already seeing it with layer ones. We're already seeing it with DeFi projects to some degree. MakerDAO, I think, is one of the oldest examples of that, and still an example today. So, but Howard, to your question, as long as people coalesce and there's a profit motive, there will always be companies.
I love your projects that is inclusive of protocols and companies. It's a good one.
Yeah, that's right on. I was going to say we definitely have a semantic quandary with respect to our portfolio, because it's definitely not a portfolio of companies. It's definitely not a portfolio of protocols either. And so we do tend to internally use the word projects more often. I would say for protocols, invariably the issuers of protocols are organizations, and those organizations are more often than not companies. I think companies will create these open networks, and then they'll also have opportunities to build businesses on top of those networks that are highly competitive, with the legacy world. And so I do think companies will stick around for a while.
I think we're out of time. Thank
predicted.
you.
Went fast. Thank you guys very much.
Nick, do you want to do the thanking, or should I?
I think we both deserve that. That was really great. And I'd love to play this back a year from now to see how wrong you were or how spot on. That was really interesting.